Hey there, welcome to Nebby Invest. Time to do a buy now, pay later video in regards to half-yearly results that most companies on the ASX released in February. So I'll be focusing on Afterpay and Zip in this video. So although there's like 10 or so buy now, pay later companies on the ASX right now, there's been a proliferation of those sort of companies over the past few years. I'll be focusing on these two companies because they are number one and number two in this sector. And the other reason I'll be looking at these two companies is I do have an indirect holding in Afterpay and a direct holding in Zip. And even though that does mean I might be a little bit biased, I'm going to try to keep that bias out of this video because I do have some concerns when it comes to the buy now, pay later sector for the future. So the agenda for this video is I'll just be comparing Afterpay and ZipPay's platform key drivers. So that's looking at sales, active customers, and I'll be comparing world and Australia and New Zealand. And there's a reason why I'll be looking at Australia and New Zealand and also merchants. So those are three real platform key drivers most of the buy now, pay later companies in Australia look at to see how they're performing. Also look at the individual results and some interesting tidbits that I find interesting anyway with their results for both Afterpay and Zip. And lastly, I'll also be doing a very brief look at Klarna and Affirm. These are two international buy now, pay later competitors of Afterpay. And I'll just be looking at their valuations. One company, Klarna, is actually a private company, but Affirm has just recently IPO'd on the NASDAQ, and that's fairly similar value to Afterpay. I think Klarna just recently came out with a valuation of $31 billion. So the first thing I'll be comparing between the two companies is sales or transactions throughout the whole world. Now in this table I'm looking at here, I do have four numbers. So what I'm doing is comparing year on year, which is half year financial year 21 to the previous half year of financial year 20. So it's year on year comparison. Also be looking at the quarter on quarter growth. So looking at these quarter numbers and comparing it to the previous quarter numbers. So that's what means by year on year growth and quarter on quarter. And when I'm looking at the compound quarterly growth rate, those two last rows there, that's looking at the year on year growth and the quarter on quarter growth. So transaction growth, we are seeing some fairly good growth for both companies. Zip has been growing stronger over the past year, and one of the main reasons behind that is their acquisition of Quadpay in the last year, and that's really accelerated their transaction numbers simply because of that transaction or that acquisition. But I can see quarter on quarter growth comparing quarter one to quarter two of this financial year. We have seen Zip and Afterpay's transaction growth accelerate, and Zip right now is 46% and Afterpay is at 39%. So not bad growth for both of these companies over the past year and particularly over the past quarter. And that's one of the reasons why Zip's share price has been rocketing up over the past month or so. So now let's focus on the active customers throughout the world. And again, well, probably should say active customers is defined as someone who has used one of these products in the past year. So you have to be using their services at least once a year to be considered an active customer. So I think once the customer base starts to slow down, they want to get their customers to use their product more and more often. But anyway, now these numbers by Zip have been influenced by the acquisition of Quadpay. So when you look at the quarter on quarter growth, that's what I want to focus on here. You do see, because this is after the acquisition of Quadpay, you do see that even though Zip growth rate is higher than Afterpay's, 27% compared to 17%. The numbers themselves are greater for Afterpay, increasing the customer base by 2 million compared to Zip's customer base by 1.2 million. So Afterpay at this point in time has just over twice as many active customers as Zip in the world. Now we'll transition to the active customers in Australia and New Zealand. That's where it starts to get interesting. And one of the reasons why I think both of these companies and other buy now, pay later companies are starting to really spend a lot of money in expanding overseas, because I think the growth rate in Australia is coming to an end, and we've definitely seen that in the active customer base from Afterpay. Over the past year, they've only grown their customers by 2.3%. In the past quarter, that's down to 0%. Zip has been increasing their customers or active customers by around 9% over the past year, and that's continued in the quarter. But what I think is happening here is most of the people who will be using Buy Now Pay Later have already signed up. So those who aren't using Buy Now Pay Later, people like me, and more than likely I will never sign up to a Buy Now Pay Later service. I just don't need it. Those like me will never sign up. So we're starting to see the point where they're getting it, or they've got as many customers as they're going to get. And what might be happening now, particularly with Zip, is those customers who've only had one, or who have only signed up to one service, are now starting to sign up to multiple services. So if you've signed up to Afterpay in the past, you've only had only used Afterpay, you're starting to sign up to these other services, and that's maybe why Zip is still increasing their customer base, while Afterpay is right at 0% growth. And finally, just having a look at merchants throughout the world for both of these companies. And in this category, it does look like Afterpay is outperforming Zip. In fact, the last quarter, Afterpay has grown the merchant base by 17% compared to Zip's 12%. And again, looking at comparing the raw numbers, Afterpay has twice as many merchants as Zip in the world. Now, I'm just going to get into each individual company's results and things that actually piqued my interest. And the first one is Afterpay's summary numbers here. They gave us in one of either the presentation, or I think this could have been in the half-year report itself. They were EBITDA positive to the tune of 47.9 million. So instantly that raises my interest. And if they didn't have these two things, share-based payments or a fair value adjustment of liabilities in regards to their Clearpay put option, if you take those two away, which is $90 million, they would have been profitable for the half year. But then again, you'd have to say the share-based payments is a real thing, because instead of paying cash, you pay shares. And the other thing I want to say is a couple of things they've mentioned as one-off items. They've actually called those one-off items 2 years in a row. And in my opinion, this is just my opinion, if you have these costs that continue over numerous years or subsequent years, can you really call it a one-off item? So the Clearpay put option is really interesting to me, because my indirect holding in Afterpay or is in regards to Clearpay, because the other 10% of Clearpay is owned by ThinkSmart. You can see here down the bottom there, read that down the bottom, right at the bottom there. Afterpay has a call option to acquire the remaining Clearpay Finance Limited shares held by ThinkSmart. So ThinkSmart is the company that I own, and there is this call option, and then ThinkSmart has a put option. So that's really over your head. It's almost over my head too. But they have to reassess the value of the put option that ThinkSmart has over Clearpay every single year. And the valuation of that put option increased by $65 million in the past half year. So about a year ago, or 6 months ago, it was only valued at $3 million. Now it's valued at $68 million. So as a ThinkSmart owner, that's actually really good for me, because the valuation of their Clearpay put option has increased by $65 million. Now, if you know anything about me, you know I really like looking at the operating cash flow of a company, because this is where you find really how a company is performing. Now, this is from their half-yearly report, and you can see receipts from customers, $8.4 billion. That's quite high. It's increased by over 100% in the last year or so. But the net cash outflow from operating activities, negative $528 million, and that was an instantaneous red flag for me, which means they have to fund their operations through other means, through capital raisings or through borrowing. So receipts are growing strongly, but the payment to merchants and suppliers has been growing quite just as strong. And I think this is just because their growth is so large, and that they're just payments to merchant suppliers that they just can't keep up with the receipts from customers. So I think growth is hurting them when it comes to their operating cash flow. But there's going to have to be some point in the future where they gain that operating leverage, where the costs are not growing quite as strongly as their receipts from customers. That's where they become profitable. So when do they reach that point? When do they reach a point where the receipts outgrow the payments to merchant suppliers? They can become operating cash flow positive, and they won't have to raise capital. They won't have to borrow. They have to reach that point somewhere in the future for this business to be viable. So how do they finance operations if they are cash flow negative in that regard? So the only two ways they can really finance operations when they're cash flow negative is through capital raisings and debt. So I've just gone through to the cash flows from financing activities in the cash flow statement to see where they are getting money from. And over the past 2 years, they've been getting money from borrowings and from capital raisings, and it seems like they do a lot of capital raising. So you can see last year they did, they received $200 million from the proceeds from issues of shares, and that is a capital raising. And in the past half year, it's $768 million. So it seems like they're getting a lot of money from capital raisings, which is dilutive to current shareholders, and that sort of thing can't continue forever. There have to be some point in the future where they have to stop raising capital, raising their debt levels, because if they can't, they're not really a viable company. So now let's get into Zip and look at some of the interesting things that piqued my interest when I looked at the results. So this is the profit or loss statement. And just like Afterpay, they have share-based payments, which came to $38 million for the half year. And they also had a fair value adjustment of liabilities, which was $33 million. And the big one was a $306 million loss attributable to the Quadpay acquisition. So even if you add all those back to the profit and loss statement, they're still not profitable, unlike Afterpay. Now let's look at Zip's operating cash flow. So if you remember Afterpay's operating cash flow, they were negative $500 million or so. Zip is positive. They are an operational cash flow positive to $13.9 million. And the reason there's a big discrepancy between Afterpay and Zip is how they deal with what Afterpay calls it payments to merchants and suppliers. So Afterpay includes that in the operational activities. Zip does not. They include that in the finance activities. So that's why Zip's operational cash flow looks really good compared to Afterpay, but you have to look a little bit deeper to understand the real truth. So for Zip, you have to go to the next thing down in the cash flow statement, which is the cash flows to investing activities. And you see a net increase in receivables here. And that is very similar to what Afterpay calls it, payments to merchants and suppliers. So this net increase in receivables was $453 million to the negative side. So the net cash flow to investing activities was highly negative. When you look at Afterpay's cash flows to investing activities, it was nowhere near that number. So that's just how they deal with that, a little bit different, subtly different. And you just have to know that these two companies are just doing slightly different things to their accounting. So what does all that mean? Well, it's just because they do subtly different things with that, whatever you call it, net receivables for Zip and payments to suppliers and merchants for Afterpay. It all means that because they have two big negative numbers in one of those two other sections, the cash flows from operations or the cash flows from investing activities, all means they still have to raise money or through either capital raising or through debt, and Zip is no different to Afterpay in this regard. You can see the proceeds from borrowings in this case. Last year it was $316 million. This year it was almost $400 million. So their debt levels are increasing, and also proceeds from the issue of shares. So both half years they've had to issue shares, $62 million in the previous year and $121 million in this year. So they're still raising a lot of money through debt and capital raisings, just like Afterpay, and just like Afterpay, at some point in the future, that has to stop. So in this slide, what I've done is just comparing Afterpay and Zip's cash flow statements. So particularly if you're watching or listening to this, or not listening, but watching this on a TV screen or a large computer monitor, you're able to see the different ways both of these companies deal with what Afterpay calls payments to merchants and suppliers and what Zip calls increase in receivables. Those are two real large negative numbers, and to fund those real large negative numbers, they need to do capital raisings and increase their debt. And the other thing I will also point out here, you can't really see it here, but the increase in marketing both these companies are doing because they're starting or trying to expand overseas at a really rapid pace, because the growth rates in Australia are coming to an end, or they've already come to an end, and they need to accelerate their growth overseas to grow or keep on growing. But at some point in the future, for these two companies to be viable, they need to gain operating leverage. And operating leverage just means their money they're receiving from their customers has to be growing at a quicker rate than the money they have to be spending or their costs. Because if they can't do that, they will never become profitable, and unprofitable company is not a viable company. And the last thing I want to talk about in regards to Zip and Afterpay is Zip's $306 million Quadpay acquisition loss. It's a really interesting read, this. I do recommend having a read of this slide, which was one of Zip's either report or presentation. Now, this is not a cash loss. This is only done for accounting reasons. And the reason it was done was because when this acquisition was approved by shareholders, the share price was $9.16, which was a big spike in the share price. In fact, you can see it on the slide there where it was approved. But the VWAP, which is the volume weighted average price of Zip shares, was $6.50. So the accountant said, instead of valuing it at $9.16, which what they had to do, they should be valuing it at $6.50, which means they need to make an adjustment to goodwill to the tune of $415 million. And I don't think goodwill is a real thing. Some accountants out there might disagree with me, but whenever a company adjusts goodwill or the value of goodwill, I just throw it away. It's not a real thing. That, again, is just my opinion. And now, finally, I'm just going to look at two competitors, international competitors of Afterpay and Zip. So, of course, Afterpay and Zip are not the only two buy now, pay later companies in the world. There are two other ones I just want to focus on at the end of this video. And the first one is Klarna. So the main reason I know Klarna is their association with Commonwealth Bank. So this is a Swedish company that began in about, I think it was 2005. And the three guys who started Klarna in that year, I think they were in a competition, this sort of entrepreneurial competition, and their idea for Klarna came last. And even though their idea came last, they decided to start up this company, and it is now the largest fintech company in Europe. They recently did a capital raising, and that put the value of Klarna at $31 billion. Now, a really good thing about Klarna is you can get some of their information online. So I looked at their presentation, and in their presentation, they gave us some very useful numbers. So these numbers dwarf Afterpay by a significant amount. So even though the valuations of those two companies are fairly similar, Klarna is by far the largest of the two companies. Active users, 87 million. They have apps, and they follow the monthly users of the app, and that's at 18 million. And USA users at 14 million, merchants, 250,000 merchants around the world, and the sales volume is at 53 billion, which is a 46% increase year on year. So those numbers completely dwarf Afterpay at this point in time. And I do think Klarna is positioning themselves for an IPO at some point in the next few years, because they do have, just like Afterpay and Zip, they are not profitable and they still have to raise money. And potentially, if they become a publicly traded company, that would mean they're able to raise more money. And I think the capital venturists that have put a lot of money into Klarna will want to get some sort of return out of their investment. And finally, I just want to talk about Affirm, a recent IPO on the NASDAQ. At their most recent share price on the 1st of March 2021, they are valued at $24 billion. Now, I did have a look at their financial presentation and numbers for the most recent quarters, and there wasn't as much information as I would like, but I did glean out some useful numbers for comparison reasons. So I did find active users, which is 4.5 million, and quarter sales volume, which is at 2.1 billion. And when you do compare that to Afterpay and Zip, particularly the active users, which is quite a bit less than both Afterpay and Zip, but their quarter sales volume is still quite a bit less than Afterpay, but is a little bit more than Zip. But when you compare the value of all three companies, I think Afterpay is valued a little bit more than Affirm, but because they have significantly higher active users and significantly higher quarter sales volume, I'd actually say Afterpay is the better value than Affirm. But definitely when you compare the value of Affirm to Zip, Zip is valued about $6 billion. There is much more value in Zip at this point in time. I won't compare Klarna's valuation to the other three because at this point in time, Klarna is a behemoth compared to these three companies, and they're not a publicly traded company. So that's all for this Afterpay versus Zip video on their half-yearly results for financial year 21. Hope you've enjoyed this video. I'm only doing these videos to share ideas, so maybe you can get some inspiration and do some follow-up research. Now, more than likely, Afterpay and Zip has been on your radar for quite a while, and maybe this is just pushes you over the edge so you can do more research in this sector. At this point in time, I am a indirect holder of Afterpay and a direct holder of Zip, but I do have some concerns for the future in the buy now, pay later sector, not in regards to the valuation, but also in regards to regulations. An increase in regulations, I think, is inevitable within this sector over the next 5 years or so. Now, I'm not a financial advisor, so if you do need to seek financial advice for your own circumstances, make sure you seek out someone who is qualified. That's all for this video. Have a good day. Talk to you later.